What is going on, everybody? It's TG back with another video. Want to do a comparison video today between Amazon and Alibaba, the e-commerce giant in America and the e-commerce giant in China, comparing their valuations, their fundamentals, their technicals, and what stock is a better buy in my opinion. So let's just jump into everything. Before we start though, if you guys enjoyed this videos, hit that like and subscribe button. It means a ton to me, but let's just jump right into it. First off, let's start off on a purely fundamental basis. When we look at Amazon right now, it is currently a $1.7 trillion market cap, very high. PE ratio sitting at 66.35. Bob, on the other hand, is a $317 billion market cap, trading at a PE ratio of 16.43. So based on just that, Alibaba is obviously a much cheaper company when you look at just those numbers. But there's so much more that comes to valuation than just a PE ratio. One of the things is growth as well. We look at Amazon's growth year over year. If we look at on an annual perspective, Amazon is growing their revenue up 37.62% year to date. Or year over year change. Net income up 84% year over year. We look at Alibaba. Alibaba on an annual side is up 40% year over year, but their net income is only up 0.7%, and their profit margins are down some as well. When you look into other factors as well, like different sectors that they have, for instance, you talk about one that's easy, gross merchandise value. Baba actually leads Amazon in that. They have more gross merchandise than Amazon, and while Amazon is catching up with that, obviously Alibaba has a lot more. They do a lot more because they are, what's it called, a business to consumer platform rather than Amazon, which is different. They have those fulfillment centers and warehouses and stuff. It's a little bit different. Now, another thing I really wanted to look at as well is not just international, because right now Amazon has established itself as a very international conglomerate. They're in many different countries, not just America, whereas Alibaba is mainly just in China. So Amazon does win that sector, and they're growing fast. About 30% of its marketplace revenue is international segment, which is huge compared to just 9.3% for Baba. Now, one of the biggest things that we have to talk about is cloud. Cloud is huge for Amazon. Why? Because it's a huge profit driver. You look at Amazon and their segment breakdown, their AWS is what brings in the most profit for them. It does a ton, and I mean a ton of money for Amazon. Alibaba also has a cloud infrastructure, but it is just not as big as AWS is here in America. So Amazon does win that. Now, another thing that it does very, very well as well is advertising. Now, right now, Alibaba is significantly better in advertising, but Amazon has been catching up a lot and investing a ton into their advertising because, again, that is another profit driver. When we look at Amazon, we're trying to find if it's going to continue to make more money. Okay, net income we're talking. That's one thing Baba does very well, is making a lot of profit. While their profit has been going down recently due to unfortunate external circumstances such as their government and different breakups in their companies, such as their Ant financial stake and different things like that, or their pick 2 system. Amazon is getting up there. Amazon is expecting to close the gap significantly by 2023, which is now only a year away. And they're spending a lot of money to get their advertising, so much farther ahead. And we're noticing that a lot. Amazon's advertising their own products, which then gets them even more on their website. If you want your product to be on the front page of Amazon to get more traction, you have to pay a lot of money for that. So Amazon does very well with that as well. Amazon also has a Prime service. We know Amazon over 200 million Prime users, and this is huge for Amazon because this makes them a fortune in free cash flow every single year. Over 200 million people paying over $120 a year. That's a lot of money, and that's a lot of free cash flow that they can use to reinvest into their company. Last but not least, I think when you're talking about valuations, it's hard to ignore how cheap Alibaba is. I will give them that. Alibaba is an extremely cheap stock. It is a growth stock with huge year-over-year growth. But the issue, and that's why they trade at a 16 PE, which is if this company was in America, I would sell every single thing I have and go all in margin and buy as many calls as I can on this company. But here's my next point, and I want you to listen very closely to this. as someone who was a big Baba investor who lost massive in Baba, $60,000 loss in Baba. So I have some experience in Baba. I can tell you firsthand that it is risky. It is extremely risky because of the geopolitical, the government in China. Again, if this is an American stock, it is the greatest company to buy in the world. But it's not. It's in China, and we've seen what China has done. They have destroyed their stocks in that country. They have destroyed prosperity for companies. They have specifically targeted rich people in that country, people like Jack Ma who speak out against it, and they go and destroy their companies. Alibaba at a time was an $850 billion company. It has been cut in half because of that. They're breaking up the business part by part. President Xi is extremely radical. We have President Biden. He's obviously radical as well, but not as extreme, and allows for a capitalist market to continue without having the power to intervene and destroy those businesses at their core. President Xi, on the other hand, communism is a lot different. And that is the biggest risk when it comes to investing in Alibaba. You're not investing in the company. You're essentially betting on their government, that they won't intervene. A couple years ago, this wasn't an issue. But recently, President Xi has picked up his radicalness, and it has caused pain for shareholders. If you look at Alibaba in the past year to date, down 48%. Same thing with Amazon. You look at Amazon year to date, it's up 6.4% and only up 3.3% in the past year. It hasn't grown much in the past year at all. Okay? But it also hasn't lost half of its value. Now, do I think Alibaba is cheaper? Yes. Would I consider buying it? It depends. And why I say it depends is because we don't know what's going to happen with this government. Also, there is an act called the Holding Foreign Companies Accountable Act. This act, if companies like Baba do not comply, then they are screwed and they will be delisted from the New York Stock Exchange. That is a big risk. If it gets delisted, yes, you will get shares in the Hong Kong market, but you will lose a ton of liquidity and that will cause the stock to crash. That is something to think about as well. Now, you look on it on a cheap standpoint, Alibaba wins that. Alibaba is a much cheaper stock at a 16 PE ratio, just as good of growth. This thing keeps popping up and it's kind of annoying, I'm going to admit. Amazon, on the other hand, trades a little more expensive, 66 PE ratio. That's much higher than the average in the S&P, and it's obviously much higher than Baba and other e-commerce plays. But what I like about Amazon is Amazon invests heavily into their company for the future. This is a company that you want to own for the long term. They're going to continue to be a player, and they're solidifying themselves as the best e-commerce platform in the world. And they're doing that with their fast delivery, their free shipping, and other services like Prime, where you can watch movies, music, all this other great stuff that comes with being a Prime member. Their business platform is to get as many people on their Prime membership as possible. And they're succeeding. They have over 200 million. Now, from a technical standpoint, Alibaba obviously is trading a little bit cheaper on the technicals because it is very oversold and trading at about a 36 RSI. Just a little bit ago, this was much lower. It had a little bit of a recovery since then, but nonetheless, it is still trading very cheap, and considering very oversold as well at a 37. Amazon, on the other hand, is sitting at about a 48 to 50 RSI. So it's about not exactly oversold, but it's not overbought either. It's actually a great place to own it. But one of the things you have to notice is Amazon has not had much growth recently in the past year, which could present a great opportunity for it. You know, you see a stock that's only up 3.3% in the past year compared to, things like the S&P, which is up, 30% in the past year. So this again poses a great opportunity to invest in a company for the long term, both of these companies. The only thing I would recommend, or what I believe, is that Baba is much more risky than Amazon, even at these low valuations, just because of the fact that China is so unpredictable, China is so radical, and they could destroy this company like that. We saw what they did with the private tutoring sector. You look at stocks like GoTo, and you see what happened to them. These were thriving companies at one point. Thriving companies at one point. And what happened? Well, right here, essentially, China decided to just absolutely destroy it. It was actually right about here. It was already on the downfall, but right about here, just took a massive hit when they took out the tutoring. They banned for-profit tutoring in China. So these companies are essentially useless and they crash. So even this, I mean, you see it on that. Obviously, it's a lot different, but you see from right here, it's a $10 stock. The next day, it's down 77%. I remember that. I remember specifically that day when that happened. But this can happen with a lot of stocks. This can happen with a lot of companies in China, and it's why I urge caution. Again, Baba's a very cheap company. There's no denying that. The only issue is who's in charge, President Xi. Amazon is an American company. America is much stronger than China. It's a much better country than China. There's no debate on that. There is debate, however, what is cheaper and what stock is a better buy. Personally, I actually am investing in Amazon right now. I have long-term put credit spreads. I closed out my Baba position because at around 150, 155, 160, something in that range. Just because I'm nervous about the government. And thank God I did, because it has fallen significantly since then. So I closed out at right about like here. And it's fallen pretty heavy since then, down to 116 now. So we'll have to see what happens with Baba. But, it's going to be a journey to see. Overall, there's no doubt about that. This could be the greatest recovery story, or it could be, another company that just gets destroyed by a great company, because Alibaba is a great company, but destroyed by its own rulers. And that's the biggest risk and the biggest potential downfall of Alibaba. So if you want safety, I say you buy Amazon. If you want a little risk and better returns potentially, buy Baba. But you have to expect that risk. You have to expect it potentially dropping under 100, potentially getting even delisted as well. And that's a risk that people have to take if they want to invest in that company. So that's just what I think about these. Again, if you want to look over the fundamentals, there's some great articles. Obviously, you can always just look on here and see their fundamentals as well. It's very interesting. But overall, I think that it's a great opportunity for investors if they want to take a small position in Baba, or if they want to go heavy into Amazon. And yeah, you could potentially see good returns since it's lacked the market by about 10x. So yeah, guys, let me know your thoughts on this. Like and subscribe, and I'll see you guys in the next video. Thank you. Bye-bye.